Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello and welcome to the LiveSquawk earnings mid-season review in association with Wall Street Horizon and Christine Short. I'll introduce Christine in a minute, but before that, just to give you a couple of pointers here. The content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor. None of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. Neither Chris and I are responsible for any losses or gains that may result from following the content on this channel. So we've got that out of the way. Anyone new to LiveSquawk, please have a look at the website, www.livesquawk.com, and have a look at what we do. We're a news aggregator for the financial market industry, and we may be of use to you if you're an investor or a trader. So take a look at that. And Wall Street Horizon, also take a look at them. They're part of the TMX group. And I'd like to introduce Christine now. Hello, Christine. How are you?
Good morning. I'm doing well. How are you?
Awesome. Very well. Thank you. Very well. We both had a bout of illness of late. So we're going to come to you. We're feeling all husky.
Yeah, excuse the congestion, but yeah, we can still talk through it.
No worries at all. There's a lot to talk about as well in today's episode, because alongside the fact that we're halfway through, a little bit over halfway through the earnings season, we have so much more really that's of interest really for both the corporate world and general financial markets anyway. So we should probably crack on and see where we're at. So I guess we better start with the equity side of things, the earnings season. How do you think, or how have you assessed the earnings season so far?
Yeah, so we're more than halfway through S&P 500 reports. I think we're at like about 65%. It's actually been a great season, like all things considered. I've been covering earnings for like 15 years. Some seasons are a little more boring than others. Last couple seasons have just been meh. I would say Q4 is coming in, pretty well. We're at about 16.5% growth year over year. That's the highest in 3 years. 77% of companies have surpassed their EPS estimates. 62% on revenues. So if I would say there's kind of a one light area, it's revenues. But kind of same old story. We tend to see around 80% of companies beat their earnings. What I'm more interested in is by what percentage they are. So
Right.
S&P 500 companies are beating by an average of 7.5%, and that's pretty healthy. Some seasons you see, they're beating, but it's by a penny. So it's like, that's not particularly interesting. Again, on the revenue side, though, we're only seeing companies beat by about 1.5%. So while companies are exceeding their earnings estimates because they've gotten really good at managing margins, we'd like to see a little bit better revenue growth, revenue strength supporting those earnings numbers. But overall, like I said, best season in 3 years. So we'll take it.
On the revenue side of things, just quickly, is there a general theme running through that on the low revenue side of things, or it's a beat, which is always a plus. Take the pluses where we can. But have you seen any sort of running theme, or this is just maybe the start of the year, just the way where we're at the moment?
Yeah, I think you always see revenues coming in a little lighter. I think it just has to do with how analysts estimate revenues. There's always a heavy emphasis on EPS. But like you said, 62% of companies are still beating revenues, so we're coming in better than expected. I think it just says that analysts were closer to the mark this season, meaning their estimates weren't too conservative. This is something we talk about a lot because companies guide low, right? The point is they want analysts to ingest lower estimates so that when they do report, it's like, oh, we beat, and then the stock pops. It's right. It's better for the stock. It's kind of a game we've gotten used to.
Right.
So analysts have just been getting, I guess, a little better at estimating revenues. So I'm not mad at those revenue numbers, but again, you want to see them more in proportion with the kind of beats you're seeing on the bottom line. But
Sure.
yeah, I don't know that there's been like an overall theme. There's certainly weakness in some sectors, which we can get into, but overall, look, like these numbers are still very strong. And the great thing that it does is that, look, this is all backwards looking. So this is for Q4. We tend to really kind of want to look at the guidance for the coming year. Not that everyone's been giving great guidance, but I just think the beat rates as they're coming in now really supports higher estimates for the back half of 2025. And so we've got some lofty earnings estimates for 2025, specifically the second half, 15% growth, 17% growth. We're already there in Q4. So I think you're going to see those estimates actually for the second half of the year go up a little bit.
So if we I want to get into obviously the new administration and the effects they have on the corporate world. We've talked about this in the past. It's quite hard, I think, in these times to maybe try and second guess the president, but I guess people will try and do that. Just to break down the sectors, any sectors that you see at the moment? I mean, let's start with the Mag 7 and their performance at back in the last year, backwards reporting, but where are the Mag 7 at the moment? And I know we've still got Nvidia to report in a couple of weeks, about 10 days or so.
Yeah, always very highly anticipated. Of course, they're sort of still priced to perfection, and so investors can be hard on these names because they want to see every metric come in better than anticipated.
Right.
We kind of kicked the party off a couple weeks ago with Meta, Tesla, Microsoft, and Apple. Pretty good, right? I think the only one that sort of disappointed was Microsoft. I mean, they beat on the top and bottom line, but revenue guidance was soft, and investors kind of took the stock down after that. Meta was kind of the winner there. Apple did okay. Yeah, iPhone sales, we know that's down, particularly because of China, but investors seem sort of forgiving there. Tesla missed on the top and the bottom line, but I still just think that's kind of like its own separate case. A lot of investors still believing that Elon Musk's close ties to President Trump will help the industry, will help, some of the regulation on that front. Last week was a bit of a surprise because you had Google and Amazon. These are two names that have been doing quite well. If we want to mention real quick the emergence of DeepSeek in the first week that we got earnings reports, there was a bit of a scare on that Monday. But you saw Amazon, you saw Google, you saw Meta all actually trade higher because cheaper generative AI is great for some of these companies, right? So after we got past the initial scare, and yes, Nvidia got hit, we actually saw some really encouraging commentary on the calls. Mark Zuckerberg saying this sort of validates our, making Meta AI free, and this just encourages earlier adoption and brings down the cost. That's great for everyone. You saw Microsoft saying, similar comments about DeepSeek having great innovation and how that overall benefits the industry.
Is this lip service? Is that lip service? Is that trying to just paper over the cracks, or do they actually mean it? Do they mean what they say? Does it actually? I mean, I know in the real world, competition is a good thing for the end user, the consumer. But again, these companies have plowed billions and billions of dollars into development. I'm not saying it's a waste, but then someone's come along and done it at a far more cost-effective. Well, so they say, at a more cost-effective price. Is it lip service, or do they mean it?
I think they mean it. It's a sunk cost now. I know what you're saying. It's wasteful. A lot of money got poured into this, but at this, that doesn't impact future guidance, right? And that's what the investor cares about. What does the future cost structure look like? Not what did you kind of already waste money on. So I do think they mean it. I think you have, even Amazon incorporating the DeepSeek's R1 AI model into AWS. And look, a couple of these names are looking at producing their own chips, Amazon being one of them. So I do think they meant it. I think the spending still looks quite high for some of these names. Google being one of them. What did they say? They were expecting capex to be 75 billion for the year. So you saw the stock kind of take a hit there because investors were surprised to see that number. I think the expectation was more like 60 billion. Google stories, if we're talking about revenue, the revenue was really, talk about revenue disappointments for the season thus far. Google is one of them, or Alphabet being the parent company of Google. You had YouTube ad revenue, search revenue, even Google Cloud revenue, which is doing so well, softer year over year. So that all of that caught investors off guard. And then Amazon, another one that everyone's expecting to do well, came in later. I think their revenue guidance was the issue there. Again, revenue being the big issue. They're looking for Q1 revenue growth of like mid to high single digit growth. And that's kind of the weakest expectation in maybe 20 years. So you saw investors react to that as well. But to your point about DeepSeek, I do, look, they had to say something. I do think they, in some regards, mean it because, like you said, overall it is better for the technology that costs come down. Whether or not DeepSeek really only spent six billion on it, and these other mega tech companies are spending 60 billion on it, it has yet to be seen. But certainly made for some very interesting comments. You have to think about the timing of that. It came just as all of these companies were reporting their earnings, so certainly made for some interesting earnings calls.
Definitely. And just to we'll stay on the point of that. The recent bid by Musk and his group to buy OpenAI, was that a serious bid? Was it just you're not in the mind of Musk or who would want to be?
Yeah.
But was that a serious attempt to try and get in the game or increase their presence, or was it just a cheeky bid?
I just think a lot of these things are distracting, right? I mean, Sam Altman said that it's maybe his attempt to not compete, or maybe that he's threatened by OpenAI, right? They kind of have this first movers advantage there in the generative AI space. I just overall think it's a distraction. I don't think this is going to come to fruition. If you watch that Sam Altman interview on Bloomberg, it got a little spicy there. So shots fired, right? It's not for sale. He made that X comment that he would buy Twitter for $9 billion. I mean, all of it's just sort of silly and distracting. But
it's kind
no,
of
I don't.
Stuff, isn't it? It's kind of macho.
Yeah, I mean, is it macho? I don't know. It's like two super nerds, but it's
there is
right.
True.
There's a bit of a dorky element there, but I find it distracting and certainly not taking it seriously. And I always wonder how. I wonder about Tesla and some of these other companies, how those aren't impacted by some of these other endeavors, and some of these other comments, but. We'll see where that goes. But I'm always keeping my eye on it. But as of what to make of it, it's like, who knows? It's just like, move on, right? It was like a funny part of your day to read about it, watch the interview, see it, and then it's like, okay, that's not serious.
Fair enough. Things to come, obviously, because we just passed the midpoint. We talked about NVIDIA, which is still to report, and that's again a couple of weeks away. But anything that sticks out in the near term in terms of sector performance that you'd like to highlight to the audience?
Yeah, we're in the second peak week, so we have about 3 kind of peak weeks of the season where a majority of companies report. We're starting to get into those like consumer names. So this week, restaurants, and then the next week we start to hear from some of the retailers like Walmart, and so you get a better read on the U.S. consumer. Thus far, the restaurant space has been sort of interesting because the fast food names in some pockets, I mean, there's always winners and losers, right? But we had McDonald's on Monday, not doing particularly well. A lot of that's due to an E. coli outbreak that impacted quarter pounders and sales. It impacted onions. And so that outbreak, I think, was declared officially over in December, but it's kind of trickled through. But then on the other hand, some other fast food names like Popeyes, um, uh, in Burger King,
Chili's.
sorry, did Burger King and Popeyes did well. Yeah, Chili's. So now then there's the full service end. So
Hmm.
you've got full service names doing well. So names like Chili's, which is owned by Brinker International, they had a blowout year. They posted 31% increase in annual sales.
Hmm.
Then you've got kind of the mid tier, like the fast casual, so like the Chipotle's of the world, not doing so well. The impact of increased food costs, things like that. So it's just been an interesting space to watch as really the lower end consumer continues to struggle. McDonald's said traffic was still there. It just was ticket ticket items, the costs that customers were paying per visit was lower than they've seen. And so it's just something to keep track of. We had job numbers out on Friday. That certainly comes into play. We saw
Hmm.
CPI this morning. So, we always say, well, the consumer's been relatively resilient considering all that's going on. We saw CPI go up. The price of things are going up, specifically food. How does that impact the consumer? And how do we prepare if tariffs, you know, do become a reality and things get more expensive? So it's all kind of a cycle here. And so we'll see what some of those big box retailers say next week, because they've been the most vocal on tariffs and how they're preparing and planning for those.
Yeah, for sure. Shall we move on to the economy? And so, in terms of last week's labour market report, we saw, was it 147,000,
I think 143, yeah.
3,000, sorry, for the jobs report. How did you view last week's number?
Still a great report. I mean, job creation was lower than expected in January,
Hmm.
but then you had unemployment, edging lower to 4%, and worker wages rose. So up to 4.1% from a year ago, and the estimate was for about 3.7%. So,
Mhm.
you have to think about how that probably made its way into Federal Chairman Powell's comments yesterday. He had that information under his belt, and labor inflation is still there, and it's rising. And so, yeah, the overall number, job creation, was lower than expected. It's certainly down from what it was in December, which was over 300,000. But this is still strong labor market. Unemployment's ticking down, and labor wages are ticking up.
Okay, cool. And then on the CPI reading today, the inflation reading, the first of the two main inflation gauges that we get over the course of every month. Obviously, the PCE deflator or price index is the one that the Fed pays more attention to, but the market gets
Right.
this headline CPI reading first. And today it was a surprise. I mean, I don't think it was the ultimate surprise, because I think everyone has been fearing that it was starting to get a bit hotter. But we did see a surprise from today's number. How do you think that ultimately affects? We can look at policy, because we heard from, obviously, Fed Governor Powell yesterday, and we're hearing from him again today, speaking to the House. But in terms of the report itself and the CPI, were you ultimately surprised by what we saw?
Not surprised, but it certainly doesn't help the case. And you'll certainly see Powell speaking to this today. Like you said, it's not their number one inflation indicator of choice, but it's what we have today. And 3% annual inflation rate is well above their goal of 2%. So we have been trending in the right direction. And actually, he made comments to that yesterday. He talked about strong overall economy, solid labor market, but an inflation that was easing.
Right.
But now that's not the case, right? And so it's now we're ticking up this month. And even with that scenario, he said the Fed didn't see the need to move quickly to ease monetary policy. When I checked, I look at the CME Group's FedWatch tool quite frequently, and after the jobs reports on Friday, I think maybe I looked Monday or Tuesday, the expectation for a rate cut this year had dropped from 2 to 1. I think earlier last week there was still an expectation for 2 cuts during the year. after the jobs report, it fell to 1, and it got pushed out more. We've been expecting maybe 1 rate cut in the first half of the year, possibly June at the June meeting. When I checked this morning, so just to look at, okay, forget March, the next meeting, the probability of a rate cut is down to like 2% today. It was 8% earlier in the week. So now that we've gotten the CP number, it's down to 2%. The May meeting, it's down to 10%. June, it's only 37%. So that was previously when most were expecting the first rate cut, or maybe the only rate cut this year to come. Now it's looking like September. There's a probability of, I think 58% that there will be some easing at the September meeting. But it's just continually gotten pushed out and reduced. And so I would just say that you'll hear that in the commentary today. And maybe as more of this kind of sinks in, those expectations for a rate cut, does it get pushed to the fall, the December meeting? Are there no rate cuts this year? Bank of America, they updated their guidance. They're expecting no rate cuts in 2025. So that's becoming more and more likely than we could have thought 6 months ago, right?
Yeah, and do you think that? I mean, I've heard traders already mention that people start mentioning hikes. It's clearly not the base case. I don't think there are many out there, but there is a fear that we're going to start hearing bank economists start to factor in, or bank desks start to factor in a hike potentially for this year. But maybe that's a bit preemptive at the moment, or a bit presumptuous at the moment. But
it's almost like no one wants to say that. But yeah, it's not, it's not, like you said, the base case at this point. But again, Powell's been sort of tight-lipped on tariffs. There's so much uncertainty, almost no one wants to say what could happen.
Yeah.
But yeah, on the fringe, you have heard that talk, but it's certainly not mainstream yet.
No, definitely. So the uncertainty we're seeing at the moment is there for all to see, and it's really premised on what we're hearing from the president and what we're seeing enacted in terms of these threats at the moment. Obviously, we had the initial tariffs placed on the likes of their near neighbours Mexico and Canada, which were quickly postponed for a month. And then the China story is also evident there as well. What do you make so far? I mean, it's a big question. What do you make of all that, and how do you see things progressing generally for the market, in relation to the market and what Trump is trying to achieve at the moment?
The markets, what they like least is uncertainty, right? Mm-hmm. And I think that's almost where we're at, with things changing at a day's notice. Companies are preparing, and they've been preparing since almost for a year now, right, for tariffs. But what I'm seeing in the markets, what I'm hearing on these Q4 earnings calls, is uncertainty. No one quite knows how to prepare, and then it's they're unable to give accurate guidance. FactSet did a great piece where they kind of tallied up, who's mentioning tariffs. Are they factoring into guidance? Are they not? And it's this quarter we've seen the most mentions of tariffs. I think half of all S&P 500 companies that have reported thus far have talked about tariffs. That's much more than we saw when Trump was previously president and initiated tariffs. There's much more of a negative connotation because of the size of the tariffs, as well as the implementation being sort of immediate rather than a phase-in, which was the case with his last presidency. And then I think of the companies that have mentioned tariffs, and about 20% have factored them into their guidance, and then fewer than that have just left them out completely. So I guess overall my point is there's still a lot of uncertainty, and it just makes it hard to know how to trade, who's impacted. Will this change? Like you said, there's already a pause on tariffs for imports from Mexico and Canada. What happens when the 30 days is over? Right now, what we're trying to understand is these steel and aluminum tariffs that are meant to go in place starting March 12th, I believe, 25%. We've heard a lot from the auto companies, which I think will be the most impacted by that.
Well, they're
How
fearful of
does
it, aren't they? I mean, they're fearful of this, and I think I've seen some criticism of them, as you'd expect, really. While we've been talking, so this isn't something you may or not be aware, but Canada's outgoing PM Justin Trudeau, has been on the wires and says that Canada will, if needed, pause its response to any US tariffs, but suggests that there will be job losses from the aluminum and steel tariffs, and it will cause job losses in the US as well as elsewhere. So, there's a little bit of shooting themselves in the foot, but again, what we've seen from the President Trump is that he's willing to bloody some noses to get what he wants for America, and he's going. He's done a lot already in his new tenure to try and make that happen. So any of this at the moment potentially causing issues down the line for the US in terms of productivity and growth. Excuse me.
Yeah, I mean, if you look at what some of these companies are saying and how they're going to deal with tariffs, the main way is to pass the cost on to consumers. Look, you're pointing out the steel tariffs. Okay, well, has that helped U.S. steel companies? Yes, prices are up. Do they have the capacity to, let's say,
That's a good point.
produce enough for the auto industry? And that's the main issue, is steel producers have to find a way to increase capacity. And in the short term, aluminum and steel might be in short supply. What does that mean? That, classic supply demand, that means costs are going to increase on an already expensive item. And these automakers in particular have been struggling, and consumers, while resilient, are stepping back on large ticket items. So if we're just talking now about these steel tariffs, that impacts autos, appliances, large ticket items that consumers are already kind of wary of purchasing, right? So the question is, can they increase supply? How long will that take? It's for some of these other companies, should we move our supply chains somewhere, let's say out of China, so that we aren't impacted by tariffs? Well, that still incurs a cost. And again, many of these retailers, even Walmart, I mean, they make 2/3 of their products in the US already, but for that remaining third, they've already, you'd think that if anyone, they have the best chance at negotiating with suppliers. They've said, no, we're going to pass that cost down. So many of them have already talked about the ways in which this would trickle down. That obviously increases inflation. That puts us at risk, certainly. Labor wages are already quite high. And so it's a cycle, and it's how short term is it? Like you said, he's willing to take the hit to overall get to some, more reliance on made in US. But if you listen to some of these calls, many of these companies have said, we've seen this movie before. We did this in the last administration. It didn't help encourage more US production. It actually encouraged just, in many cases, higher costs, right? Because these supply chains, these production centers that these companies have are, it's billions of dollars to move these. And so they're not willing to do that. So they're just going to try to pass on as much as they can.
Okay, it's interesting. Thank you for that. We're coming to the end of the episode today. Just to wrap things up then. So earnings season so far, we've seen, as you said, EPS is healthy, but revenue at 1.5% average is probably less so, but again, it's still positive in that sense. For the end of the season, we got, as I keep mentioning, video because it just seems to be the one that moves markets around at the moment. Any final bits and pieces you want to look at from the corporate perspective, really with the earnings season and equity markets that might be of interest to the listener?
Yeah, let's end on a positive note, right? Because that tariff talk can get a little dark. But yeah, I mean, U.S. corporations are still doing really well. Like I said, you're going to hear more from the retailers, which gives you a better idea on how consumers are faring. And it's really less backwards looking now. We care about Q4 numbers, but we want to hear about guidance, which might be a little less certain since, thanks to some of these policies that we're waiting to hear more on. But overall, 2025 looks like a strong year for earnings growth. and I think companies are still holding to that for now. So I'll just be looking for some enterprise tech names coming out this week, some consumer names in the next week. You talked about NVIDIA coming out on February 26th.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.